Welcome back. Well, we do have the details with regards to the Nucleus Software buyback. So it's worth around 72 odd crores as a total, and it's come in at 1,615 rupees per share. That's what the board has approved. It equals to around 1.67% of their total equities. So that's the update which has come in with regards to Nucleus Software. But the stock, as you can see, is down around 4.5% at this point in time. We'll get you more details. But as of now, we have a management to talk to. We have Mr. Raghu, who's the chairman and the MD of Updata Services, joining in to discuss the quarter gone by and what the business is looking like. Mr. Raghu, thanks very much for taking the time out. Well, I just wanted to start by talking to you about your integrated facilities management business, which is the bulk of your business. It was up around 6.2% on a year-on-year basis, up around 1.1% on a Q-on-Q basis. You have indicated that, Q2, Q3 generally sees better growth. So what is the kind of growth that we're looking at in Q2 and Q3?
On the IFM side, I think between first quarter last year to this year, first quarter is about 7.5% growth. Like I called out last time, we had exited unviable business, so this growth is slightly muted. However, for this current year, what we had guided was about 15 to 16% growth on the IFM side.
Right. What's interesting is that from the time when we started to speak from your IPO days to now, there's been a sharp increase in the contribution that has come in from the BSS business, which is a higher margin business for you, and that's reflected in your overall EBITDA margins as well over the last many quarters. So going forward, what is this proportion likely to stabilize at? And at that level, what are your margins likely to be? Because IFM, while it's growing slowly, it's a low margin product and there is increasing competitive intensity. In BSS, while it's growing fast, I'm sure at some point there could be worries about margins there too. So on an overall steady state basis, what is the sort of margin and contribution that you expect from both these businesses?
Yeah, great. BSS, we had consciously, strategically tried to increase revenues there, ramp up growth there because they're higher margin. That was the strategy from the beginning, and that's what is working out. On the IFM side, yes, we will grow double digit, about 14, 15, 16% this year, but the margins will be around between 5-6%. For our BSS, it will be steady state of what, 12 to 14% margins. So that has been the plan, and that's what it's actually planned out for this year, and I can see in the near future.
The contribution of BSS then over the next couple of years, you expect it to go to 40-42%. At what point does it stabilize and you stop consciously, growing BSS faster than IFM?
I don't think in the near future we'll stop because we want to grow a more profitable business. As of today, it's about 35% of revenue and about 65% of our PAT. So that I think we consciously will grow this, as much as possible. That's the idea. But this year we will reach between 60-40, 60 between IFM and 40 for BSS.
Okay, but if I just look at your IFM business in the past 4 quarters odd, it's been single-digit growth. And it's slowly scaled down. 4.8% in Q3 and then now 6.2% in Q1. But just give us a sense in terms of what is the average run rate that we can expect. Are you going to push to double-digit growth, and by when?
For the full year, we will be a double-digit growth. If you look at quarter on quarter compared to last quarter, yes, it's single-digit because like we called out as last time, we have exited businesses in IFM which is not viable. So that's the reason the growth looks muted. But if you look at the full year, we will still do between 14-15%.
So when you talk about these unviable contracts or the businesses that you exited, what was the reason for exiting? And has that improved the margins within your IFM segment? And if so, to what extent?
Absolutely. I think it would margins would improve compared to last full year to this full year coming 25 March, would about close to about 50 to 75 basis points. That is a margin improvement we will have. When we say we exited businesses not viable, are not very profitable or operational difficulties to do in certain geographies. So this is a conscious call, and I think that was the plan earlier also.
Right. So margins will improve this year. final question before we let you go. On the recent increase in investment in Denave Limited, Denave India, I don't know how to pronounce that. You increased your stake from 67% to closer to 90% at 50 crore rupees, 52.57 crore rupees. If you could tell us, if there is any commitment for you to increase further stake out there, the rationale for actually increasing your stake here, and how much more are you looking to increase your stake in some of the other subsidiaries that you've acquired earlier?
No, all our subsidiaries are 100%, but for one company called Athena, which is 76% as we speak. Denave, we've already acquired 100% as of last year, 31st March, but the money moved later after 31st March. So our strategy of acquisition is we don't acquire 100%. We take a majority on day one and give an earn-out model for the promoters for about a couple of years. So Denave is 100% subsidiary as of today. So there's no more investment in Denave. That's over. So there's only one subsidiary, Athena, which will happen next year.
And how much do you intend to
that depends on how they perform. It could be anywhere in the region of about 30 to 40 crores because we have an earn-out model.
Okay, so you would be investing around 30 to 40 crores in this additional subsidiary. And where are you getting the funds from?
These funds are through internal accrual. And already, if you look at the way we account, we take it 100% in our liability in our books. It's already accounted because we're committed to buy.
Okay.
All right.
Any more unviable contracts that you would be exiting?
In the IFM space, no. We are now done with it.
Okay. All right. All right. Well, we're going to let you go on that note. Thanks, Mr. Raghu, for joining in and taking us through that conversation. Well, that is updated. That stock is up around 3.3% at this point in time. They are targeting double-digit growth in their integrated facilities management segment. So that is what they're looking at for the year. We'll take a break, but more on the markets once we're back. Stay tuned.